So what we're going to do today is first I'm going to go through the deliverable dates, delivery dates, key milestone dates. So the first draft of the memo, I should be looking at those now. Tuesday, February 28th, so ideally she'll meet those before that. And then the second draft will be due on Thursday, February 30th, and we'll continue to go through them throughout the semester until they're perfect. And I would try to get the template or the format down as soon as possible so that then we can start looking at the text and you can start replicating across the different asset classes. Okay? We're going to go through a quick update on the markets. Kind of curious what the market's feeling about the CEO briefing that just got over in Washington, D.C., the Trump administration I watched. A lot of it was pretty optimistic. Curious what the stock and the bond market did in response. And if you can give me the data, but give me some reasons why you think the market went up or down. So start conducting the analysis. I'm going to try to burn through the statistical pretest and really hit on some of the key takeaways, which is really model building, was what I was trying to get out of that exercise. Are you comfortable building models? Are you going to be building models? Somebody asks you to build a model. Do you know how to build a model? Do you know how to build a model? If you don't know how to build a model, that's what we're trying to get. And then we'll go through chapter 4, financial statement analysis, and then I'll talk about yield curves and yield curve dynamics and the dynamic yield curve, because basically all returns, all cost of capital, all asset prices, all stocks, all bonds, all real estate, all commodities, everything's priced off of the yield curve. So if you can understand yield curve dynamics, you can pretty much understand how to forecast where asset prices are going in the future, and that might be a little valuable, especially if you're going to go work for a company and you're getting stock grants or stock options, and you're probably have 401ks or self-directed IRAs at some point. You may be investing in securities, stocks and bonds, and you want to know what the yield curve is doing. So we'll go through yield curve dynamics and how that feeds right into interest rates and discount rates and expected return determinations, and how that flows right into asset prices and asset price determination. So it's a lot of materials to get through. And again, what I'll do is I'll try to go through the materials, and then throughout the semester you'll hear me repeat a lot of these theories over and over and over again, just to reinforce and grind them into your brain so that you memorize them correctly. The homework is due on March 9th, and the in-class quiz will be over a couple days. It'll be on the 14th and the 16th. And then deliverable 1 will be due March 16th. Okay. And I've already provided you with some examples of some pretty good deliverables. I had a class last night at another school, and I thought it was really interesting. Some people just did not get the deliverable. It's just so foreign to them because they're so used to submitting pieces of work and getting grades, and, and then moving on. It's like, no. You're going to put together the package. You're going to submit the package. The package is going to be reviewed just like it was reviewed, by a managing director. I go through it. I see where the weaknesses and the strengths are. You move on from the strengths. You go back to remediate the weaknesses. So it's an iterative process. Okay. When you start working in the real world, you're not going to be submitting work in a one-shot deal. It's going to be iterative. It's going to be a process. It's going to drive you crazy, and it's going to be extremely frustrating because probably the initial work product that you deliver and you produce is going to be subpar and will not be superior. But the process of working with somebody and working with a team and going through the revisions and the iterations and increasing the quality of the product will eventually get you to the business quality product production level, and that's where we want to go. We don't want to go stay in the academic world. We want to go to the professional business world because that's where we're going to operate. And once you get there, your standards will never go below that. You're stuck. You're always going to have really high standards. So when you go into grad school or you get promoted, you walk in with extremely strong skill sets, and depending on who the students are that are going to be around you, in grad school. Hopefully you go to a really good school. They're going to be stuck in the academic world, and you're going to be stuck in business, and you're going to blow them away completely. You're going to blow the professor away, and you're going to do really well in your program. Okay? Any questions and clarifications on this? Okay. And I do highly recommend that you take pictures of everything after the lecture. Even though I'm videotaping, it's really good to, maybe you're sitting there in a line somewhere and you want to review the lectures. So it's great technology now to be able to have, you know, not only the lectures on video, but also the lectures on your handheld to be able to review. You guys are in a great position in history. The statistical pre-test, I don't know if you have it with you, but maybe you can walk me through. I don't know if print out. Maybe somebody can tell me what the value of the law of large numbers is. What are we trying to get at when we're trying to get large data sets of normalized or standardized data? What's our goal? What are we trying to get to?
Closest collective whole population.
Yeah, we're trying to get to the population, and what are we calculating with the population? What are the two main statistics that we're trying to calculate?
Standard deviation, the variance?
Yeah, standard deviation, the variance, and the mean. Okay, and if I have very large data sets of financial ratios, or logged stock prices, or percentage changes in a large sample, what is the distribution going to look like? As I start to add more normalized or standardized data to the sample, what happens to the distribution in the data? It becomes what? I can't hear.
Normal.
It becomes more normal. It becomes normally distributed. That's the goal. Okay? The goal is to work with data that is normally distributed. Okay? Because then you can use mean variance analysis. And mean variance analysis is the basic underlying statistical application in finance, in accounting, in marketing research, in operations research. You have to get to normality within the data sets. Okay? So as you approximate normality, you're going to have to start measuring central tendency. The central tendency measures that you're going to use is probably the mean, median, and the mode. All right? But in most cases, you have to use the mean. But what's the problem with using the mean sometimes, as opposed to the median?
There's outliers.
There's outliers. And if there's outliers in the distribution, what happens to your distribution? It becomes skewed. Right? So there's a bias in it. So how do you normalize the distribution so that you can use the mean, not the median? What do you do to the data set to get the distribution to become more normal? What would you do? What would you do to the data sets? You just mentioned it. Okay, what's the problem with using the mean?
There's outliers.
There's outliers.
You check
Okay.
out the outliers.
So what would you do to normalize the distribution?
You check out the outliers.
You get rid of the outliers. Okay. How do you get rid of the outliers? Well, one, you normalize the data. You probably want to take notes. You normalize the data, okay, or you make sure that the data is normalized. You might have to log the data or use percentages or some kind of normalization process. And then you filter the data. You filter out the outliers by using the standard deviation. And you filter out plus and minus 2 standard deviations from the mean. Okay? That is extremely critical to understand. Pre-test was not only a test of your comprehension of the statistical applications, but it's also for me to train you on some of the nuances in data analysis that I've learned over the last 25 years as being a market research director. So the key is you need normality in the data so we can calculate the mean, but you may get skewed distributions. So what you do is you make sure that the data itself is normalized, and then you calculate the standard deviation, and you get rid of the outliers outside of 2 standard deviations. and that's going to normalize the data set. Now what you then do is you go back and you look at these outliers and you make sure that there's no coding errors or calculation errors. So you validate and verify the outliers. And if you can validate and verify the outliers, you throw them back into the sample. You throw them back into the sample. And if you find errors or outliers that don't make sense, that you can't verify, then you just throw them out and move on. Okay? So this allows you to calculate the true sample mean that approximates the population mean. So it's really important that you understand the filtering process. Now, it's always nice to be able to use medians, right, midpoints. Within the distribution, you just rank from high to low. You take a midpoint. Well, that's great, because you took care of the outlier problem. But the problem is you don't use medians in mean variance analysis in finance, in accounting. You don't use medians, you use means. So you got to do a transformation process to be able to get rid of the outliers and use the mean. Okay. What else in the pre-test? Can I borrow yours for a second? Thanks. So I wanted to see the, show me the bell curves on the arithmetic and geometric means. Show me the calculations. The arithmetic means have problems too because you have outliers in them. Geometric means basically control for outliers. And in financial reporting, when you're reporting returns on portfolios for 1, 3, 5, 10 years, you're using geometric means, not arithmetic means. Okay. So these are just nuances. And then I was looking for, can you show me a normal distribution? Can you show me different types of distributions? There's binomial distributions. Again, I got problems there. And exponential distributions, skewed distributions, Poisson distributions. If you move on into marketing research or operations research or accounting or finance, you're probably going to do what's called simulation. Using simulation. And you're going to use what is called Monte Carlo. Simulation, where you're doing simulations, stress testing your models. You have to plug in the simulation model what the distribution type you're using to be able to replicate and stress test the model. Okay, so understanding the distributions are extremely important, and understanding different types. We talked about central tendency, mean, median, and mode. We don't use a lot in social sciences, but if you're working for a bank, on the op side, operations, particularly looking at bank accounts and bank account transactions, you're probably going to be using the mode because you're going to have data sets in the 50 to 500 to maybe 1 million transactions. So you can use the modes in those types of environments. But when you're conducting data analysis and forecasting in finance and accounting and economics and operations research, in those cases, you're going to be using a smaller sample sizes. Okay, so it really is important to get to normality very quickly. And if you can get greater than 20 sample sizes, you're going to approximate a normal distribution pretty quickly. And I've actually reached normality in some of my data sets because the distributions are really tight around the mean. I was able to get and assume normality with 5 transactions. So, but I had to observe and do some simulation to verify that. Skewnesses in the distribution. Kurtosis is the peakiness. We don't have liptosis in there. And basically, liptosis says that the distribution is relatively flat, and you have fat tails. Now this is pretty bad because you have a very large variance and a high standard deviation, and you have high probability of outliers. i.e. asset price bubbles and financial crises. In those cases, we don't assume those. We assume a more normal distribution, but in asset price bubbles and financial crises, they are a reality, but they're in most cases assumed away in your scenarios, but that could be actually very dangerous. So you might have to do some stress testing under an asset price bubble or a financial crisis scenario to get a true impairment on the portfolio values or on the bank's balance sheet. So you might have to do that. Histograms are just basically distributions, basically just breaking up the distribution into ranges. So I could do a range of the total return on the S&P 500. I could do total GDP distributions over a 50-year period and get an idea of what the distribution has been and what's the mean been. On the stock market, it's been 10% over a 20, 30-year period. If you look at the GDP, it's been roughly 3% over the last 20, 30 years. So you can create distributions out of histograms. The stem leaves basically show you occurrences, and again by number of occurrences. The box plots show you highs and lows and quartiles and means and medians within the box plot. And if you turn the box plots upside down and look at, maybe this is daily or weekly stock prices on Apple, you can create a time series of box plots and then be able to use those box plots as a way to do trend analysis, to be able to forecast the direction of the stock price using statistical analysis. So this is all data analysis, data representation. You calculated the variance, that's dispersion. That's going to, in finance, that's risk. And then you take the square root of the variance, and that's going to give you the standard deviation, which is a unit of risk. What's great about the standard deviation is if you can calculate the mean return on the stock market, and you can calculate the standard deviation on the volatility in stock prices, and you divide the expected return by the standard deviation, you can calculate a risk-adjusted rate of return. That's extremely important for investors to know. I mean, investors need to get a minimum rate of return on their investments, but they want to lower the portfolio standard deviation so that they can increase the risk-adjusted rate of return. If you can do that, money's going to flow into your portfolio, flow into your firm, flow into your investment strategies. So the risk-adjusted rate of return and the standard deviation is extremely important. The expected return is basically a unit of return. The standard deviation is a unit of risk. So this basically gives you the unit of return per unit of risk. So if this is 10% and this is 10%, then you're getting 1 unit of return per unit of risk. If the standard deviation drops to 5%, I'm getting 2 units of return per unit of risk. If the standard deviation goes to 20%, I'm getting 0.5 units of return per unit of risk. So it's a way of being able to assess different portfolios. I'm looking at 3, I need to decide which one I'm going to invest in. This one's giving me 1 unit of return per unit of risk. This one's giving me 2, and this one's giving me 3. Which one are you going to pick? I'm going to pick 3. I'm getting 3 units of return per unit of risk. And you'll see as you move on and do more advanced statistics and accounting and finance and ops and internet stuff, using large amounts of data, using the standard deviations and the variances are tools in which you're going to use to analyze the data. The confidence intervals basically gives you how tight, do the majority of the observations fall within 2 standard deviations from the mean. confidence levels, 99, 95, 90. As you move down, you're letting more error into the sample, and your t-statistics actually become more significant. In the sciences, there's 99% confidence levels, because you have thousands of transactions or thousands of data points, especially in biology. But in social sciences, you use 95 and 90. You have to relax and allow more error in, because you usually are limited to your data sample sizes. The Z statistic is the student T, which tests for statistical significance of your independent variable. The Z statistic also can be used to normalize data sets. So I can normalize the data set by calculating for each of the individual observations. I can take the actual observation, subtract out the average, divided by the standard deviation, and I get a Z-score. Z-scores are extremely important when you're doing model building, because it's a standardization process. I can create an index out of this, I can create a weighted index out of different Z-scores based on factors that I've identified that are going to help me predict the dependent variable. Either be profitability, or sales, or revenues, or stock returns, or stock prices, it doesn't matter. The t-statistic is the individual independent variable. T-stat that tests for statistical significance of the independent variable's ability to predict the dependent variable. And the t-statistics range between -2 and +2. And if you ever see a +2 or -2, there's something wrong with your data, because there's no way it would ever be that strong. So you want to look for t's in and around probably 1 and 1.5 as a benchmark. You may want to write this down on your exams. Write down some of the nuances that I'm giving you, because I went through brain damage, of getting the master's and econ, the doctorate degree. So I went through a lot of that stuff. So I'm trying to save you some time. Okay. And then the F statistic is basically the model statistical significance. How does the model do in predicting the dependent variable? How do the independent variables as a set of variables, as a model, predict the dependent variable? And the levels, probably as low as 4. 8 is really good. If you start getting into 13, 14 and there, you have too many variables in your model and you have multicollinearity. You have problems with your model. You overfit it. It looks better than it actually is. Coefficient of variation, I already talked about that. It's basically the standard deviation on the portfolio divided by the expected return. The inverse is the expected return to the standard deviation. So I can score these portfolios using the coefficient of variation or the risk-adjusted rate of return. So if I'm looking at return to risk ratios, then I'm going to pick 3. I'm using coefficient of variations. I'm using 1. I'm picking A. So the coefficient of variations, you want the lowest. In the risk-adjusted rates of return, you want the highest. Are you writing all this down? Covariance, if you look at it, is just the volatility between the two stock returns. And if there's low covariance, that's going to affect the portfolio standard deviation and is going to reduce it. The returns are not related to each other. They do not covary together. So if you add stocks to your portfolio, or bonds to your portfolio, or real estate to your portfolio, whose returns have low covariance with the other returns, it's going to lower the portfolio standard deviation and you're going to get diversification. And that's really the key in portfolio building, is to reduce the covariance and correlation in the returns. And this could be product lines or divisional lines within the company. I have 5 divisions within the company. I don't want the cash flows of each division to be highly correlated with each other. Because if something happens in the market and it affects all my divisions, I'm going bankrupt. But if it takes out one division, I can probably manage it. Because we diversified across product lines, or across demographics, or across economics. And then the correlation coefficient is just the covariance divided by the standard deviation for each of them. here you have the covariance divided by the two standard deviations. You're basically normalizing the covariance to get it to range between +1 and -1, or 100% or negative 100%. And the correlations are extremely important, because if I'm building a portfolio or a company, and my cash flows and returns on the stocks that are in the portfolio are highly correlated to each other, I got no diversification. I have no diversification. So what I'm looking to do is to add assets to the portfolio that maybe have low correlation with the returns of the other stocks in the portfolio, or have no correlation whatsoever, or have inverse correlations. They move in the opposite direction. So if I'm building a portfolio of stocks, bonds, real estate, derivatives, whatever is commodities, and I want to diversify the portfolio, again, to lower the portfolio standard deviation, I'm going to add assets to the portfolio whose returns have low, no, and negative correlation with the other assets in the portfolio. And I'm going to get diversification. And I'll talk more about portfolio theory later on. If the covariance goes up, the portfolio standard deviation goes up. If the correlation covariance goes down, portfolio standard deviation goes down. I was looking for a regression equation, and this one's correct. Where you have y hat equals the intercept plus the beta on x on plus, you went ahead and did the calculations. This is the coefficient. These are the beta coefficients. I'm just going to do a 3 model. So you have the error term, it's an estimate. Beta coefficients are estimates, along with the dependent variable for estimates. You're going to either a time series or cross section. If it's time series, I'm basically doing it over time. If it's cross section, I'm doing it in one time period over multiple firms. Run the regression, pumps out the beta coefficients. I pump in the forecast variables, and it's going to forecast the dependent variable. Could be revenues, could be sales, could be turnover, could be profitability, whatever it is you're trying to model out. You want to minimize this. You want to minimize the error. Obviously, that means that it's a good predictor. If these t statistics are statistically significant, you're in. The f statistic is good, you're in. And if the adjusted R square is relatively high, you're in. You got a good model. Okay, so you have to do some of the regression diagnostics. What are the dependent and independent variables? That's what you're trying to forecast. These are the variables you're using to build a forecast model. So what I'm trying to do is to program in your brain a mathematical equation that you can use to crank through and start thinking about model building. How would you select and determine variables in the model? Well, first, somebody's going to come up to you and say, you need to build a forecast model. Great, is the first thing you're going to say. Great, yes, I will build that model for you. What do you want to forecast? So the sponsor is going to tell you what they want to forecast. Then the second question that comes out of your mouth is, what do you think? What variables do you think should be in the model that's going to help predict the sales projections over the next 5 years? What variables do you think should be in it? Oh, and by the way, can we have a meeting and get everybody together in the senior management team and some of the other key personnel and do a survey and find out what everybody thinks should be in that model to get internal validity and get buy-off by senior management on the first round. Then you're going to do external validity. You're going to go to the library. You're going to research how to forecast sales within a tech company, whatever it is. And you're going to see if there's been any peer-reviewed journal articles written by academicians or industry professionals. And you're going to review the literature and the theory and look at the variables that they've come up with consistently over time that validates externally your internal variables in your model structure. So you get both internal validity and external validity. You got to do both. And if you can build the model and then back test it, and it does a good job of predicting, and then you forecast in a short period in front to validate that the model is tracking correctly, then you can put together the presentation, go to the board of directors, make the presentation, make the recommendation to the company. Okay? And know that you can handle any questions that come at you from the investment committee, board, or senior management. You can totally nail the presentation, and if you can do that, you're going to be extremely successful because you get promotions and bonuses and wage increases, and if they don't give it to you, you basically take that intellectual property and you go to another company where you can arbitrage. What tests variable and model statistical significance, the t-test, the f-test, the adjusted r-squared test. You're just looking to see if you understood from the prior example, how do you test variable significance and model significance. What is the problem of multicollinearity? Okay, you overfitted the model. You got too many variables in your model. Do not put more than 5. No more than 5. And if you have just one variable in the model, that's probably not going to do a good job. So you need at least 2 and no more than 5. Okay? Now here's the problem. If you have too many variables in your model, what's going to happen is one variable is going to be highly correlated to the other variable. And that variable is going to be highly correlated with the dependent variable, and this one's also going to be highly correlated to the dependent variable. So you have 2 variables in your model that are highly correlated to each other and highly correlated to the dependent variable. The question is, which one do you keep and which one do you get rid of? This is a big problem. Okay. And this is where the students make their mistakes. Okay. Based on students, in academia, in industry, in practice. The students would say, I would pick the variable, the one to stay in, that has the highest t statistic, and it has the highest correlation with the dependent variable. That's incorrect. Okay? The one that you pick and leave in, since this one is already statistically significant and highly correlated with the dependent variable, is you would check the literature. You go to the peer-reviewed journal articles and you look at the literature, and the one that's cited the most in the literature based on theory is the one that you keep. You might get some variables that have been internally verified by senior management, and then you have other variables that have been verified through theory. And then if they are still statistically significant, highly correlated, you've built a great model, back test it, see if it works, forward test it. If it works, boom, you're in. You win. Okay, so there's an art and a science to this. What's the difference between unsystematic and systematic risk? Unsystematic risk, or business-specific risk, can be diversified away by adding assets to the portfolio with no low or negative correlations. Okay? So you can diversify it away the more you add. The only thing that's left at the end is going to be systematic risk, systemic risk, structural risk, market risk, economic risk, political risks, all the risks that you can't diversify away. Because everybody in every stock is exposed to those risks. What type of risk can be diversified away? We already talked about. Okay, that's it. Okay, any questions on the test? Okay, so that's like the underlying foundation. For the class, you'll see a lot of this stuff repeat again as we start moving through the course. And make sure that you keep your statistical pretest handy, because I'll be talking in this type of terminology going forward. And if you don't understand it or you want me to repeat it, stop me, okay? And I'll go through it again to make sure that you understand. Okay? So let's do chapter 4. Who's going to be my timekeeper today? Okay. Can you, how much time do we have? An hour? Okay, so give me a 50, 40, 30, and 10. Okay, thank you. So chapter 4 is financial statement analysis, and I know that you're accounting majors. I hear that's a pretty brutal class. We're just going to do it at a very high level. The financial statement analysis is extremely important because you have access to the data. and you have access to the financial statements that have been produced under GAAP accounting standards. And all publicly traded companies have to have audited financial statements, and most of those are non-qualified. So it's great because you have one standard in which the financial statements have been produced, so that you can analyze them and conduct financial ratio analysis for benchmarking and performance evaluation. So it's great. So there's different types. There's common size analysis. I'll go into that. Financial ratios, and some of this should be somewhat of a review from your financial accounting class, and maybe your managerial. We'll get into the DuPont system, which is the calculation of the return on equity. How you use these ratios for benchmarking, and what are some of the limitations associated with the ratios. I really don't talk much about that, but they are accounting ratios, and there are lead lags within the data. So maybe the information is backward looking, it's not pro forma. You may want to write that terminology down. Pro forma is projected financials, and then most financial statements are historical. But management in those conference calls may actually guide you and state some pro forma income to help guide you and help guide analysts and help guide the stock. The financial ratios are used by stockholders and managers, creditors. The stockholders are looking at cash flows, risks to the cash flows, rates of return, and the market value of the firm, so going up or down. Managers are also looking at rates of return for benchmarking, efficiency ratios. Are we running at the business optimally to control costs? We're looking at cash flows, market values, and then job retention. Do we need to hire more people because our sales are going off the charts? Or we're projecting a new product launch, and we better start staging HR to start hiring people because our sales are going to go through the roof. Creditors want to see predictable expenses and revenues and cash flows and cash flow growth rates because they want to know that they're going to get paid back on the bonds. They want to know that you can meet short-term obligations, you're not running into liquidity issues, that you're not over-leveraging the firm by issuing too many bonds to try to juice the stock price or the return on equity. Yes, managers do that. And then can they make the loan payments, on the mortgage or business loans that they may have taken out. The common size statements are really just, you take the dollar amounts, let's say for the assets, the liabilities, and you turn them into percentages. So it's basically what is the percentage of cash to the total assets, or percentage of inventory to the total assets, or goodwill. So you're basically standardizing the ratios. Once you've done the common size analysis, you can use trend analysis and then conduct variance analysis to see if we're moving outside of some optimal percentage. And it will trigger an alert, mainly on your dashboards, if you've created accounting control systems with common size ratio analysis. So you're monitoring the ratios on a constant basis, and when they get out of control, it triggers a signal so you can go in, drill in, figure out where the problem is and correct it, and get the ratios back in line through some kind of optimization or some kind of calibration that you're trying to do. And now with the amount of data and big data analytics, we can program all of that stuff and create really cool dashboards to be able to monitor and alert us if anything gets out of control. So we can look at common size ratios over time. We can compare it to direct competitors. We can create weighted averages and do a peer group. We can compare it against a budget. We can compare it against some industry benchmark. And then we could just program all of this to do, again, a dashboard and forms. So you can create, if I know the actuals for the company, I can compare it to the budget, I can compare it to the peer, I can compare it to the industry, I got the variances, and if they get out of control, boom, I get alerted. Financial ratio analysis, again, I can look at trends, return on equity, return on assets, profit margins, PE ratios, whatever it is, I can look at it over time. I can build a forecast model I want to predict return on equity, which is probably a pretty smart thing to do, or return on assets. I can probably build a model of other financial ratios and drill right into the return on equity, test it, predict it. I can predict return on equity. That would be pretty awesome to build a return on equity model for a company. Can you move the camera over? Thank you. You can compare the ratio against direct competitors, peer group, industry, and variance analysis. We can, and this is key right here. So a lot of this is not really in the book. So through the financial ratio analysis, you can determine the overall financial condition and position of the firm. It's considered fundamental analysis. So what you're trying to do here is you want to compare your firm's financial ratios to a direct competitor. This is what we're going to do at the end of the semester. We're also going to calculate the peer group ratios, and I'll walk you through the math on how to calculate the peer group ratios. And you're also going to be given the industry ratios. So you'll be able to compare the direct firm, the target firm, to the direct competitor, the peer group, and the industry. And from those financial ratio analyses, you are going to come up with an overall assessment of the financial condition and position of the firm. Okay? So when you do the analysis, you're going to have the firm ratios, you're going to have the direct competitor, the peer group, and the industry. And then you're going to have the ratios. What you're going to do is you're going to analyze, compare to the direct competitor, but really the most important is the peer group. Are we outperforming the peer group? Are return on assets, return on equity? Are we under leveraged compared to the peer group? And then it's important to be able to look at the direct competitor. So if we're doing Goldman Sachs, it's JP Morgan. If we're doing JP Morgan, it's Goldman Sachs. If we're doing B of A, it's Wells Fargo. So you got to be able to do the analysis. It's going to be easy. These companies are going to be easy to beat the industry because these are the top 5 firms, right? The one that we're looking at, 2 firms we're looking at, rank in the top 2 of the top 5 companies. These are really well-run companies. Very rarely will the ratios be below the industry ratio. Okay, so you really have to step back and look at it. And then what you do is you score the performance of the subject firm against the direct competitor and the peer group. And then you score it and you give it a score. Okay? And the scores can be excellent, good, above average, average, below average, and poor. And in most cases, they're not going to be down here, they're probably going to be up here. Okay? So you have to use this language, these terms, okay? You can't use totally awesome or killer or, amazing or something like that. You gotta use it exactly these. Okay? So then what you're gonna do, you're gonna come over here and you're gonna do the analysis and okay, excellent. This is good, good, average, good. And then you're going to step back and take a look. And it looks to me like the overall, they had excellent, average, mostly good in their financial ratios. It looks like it's been mostly good. So I'm going to give an overall financial condition and position for the financial ratios that have been presented here. Good. So the overall financial condition and the position of the firm is good. That's the fundamental basis and analysis that you have to conduct before you start doing the securities analysis, before you start doing the valuation. Okay? So you score the financial ratios as comparison to the direct competitor in the peer group and the industry, then analyze the overall scores, then give an overall condition for the financial position and condition of the firm. Okay? The peer group, you should definitely take pictures of all this stuff, definitely take pictures of this. This is the hardest part. Students just can't calculate weighted averages. Okay? They like to take averages, or they just say, screw it, I'm not gonna calculate it, I'm just gonna make it up, or I'm gonna take it from the sample report that Larry gave me, and I'm just gonna plug the number in, because I can't calculate a weighted average, it's too hard. Okay? I've seen it. So, the way you set up the weighted averages, here's the 5 firms. Okay? You have the total assets, you could use revenue, or you could use total value of the firm, it doesn't matter, we're gonna use assets to make it simple. You add up all of the assets for the top 5 firms, and then divide them back individually to get the percent. Percentages you add up to 100. Then what we're gonna do is we're gonna take the financial ratio, let's say the return on equity, and we're gonna multiply the weight by the ratio to get the weighted ratio. We do that for all 5. We sum up the weighted ratios to get the weighted average for the peer group. That's it. Is that hard? No. But it's really, for some reason, the students have a hard time. I think it might be just a math phobia. And you guys got to get over math phobia, because what I recognized, and as you saw on the screen, all those CEOs of these major companies, they're good in math and they're good in marketing, communications, they're good at everything. So we got to be very comfortable with both the math and the soft skills also, because they go really well together. And if you're weak at one area over the other, you go remediate it. You become good at that, and then you get really strong intercommunication skills. And if you're good at intercommunication, weak at math, you go remediate that. That's what I did. I was not very good at math, and I just said, screw it, I'm going to study finance and econ. Just get over it. Financial ratios, they're broken down into 5 categories: liquidity, efficiency, leverage, profitability, and market values. Liquidity, current ratio, it's just current assets divided by current liabilities. Quick ratio, current assets minus inventory divided by current liabilities. So this gives you liquidity, the ability to meet your short-term obligations as they come due. Efficiency, inventory turnover. So obviously these you want to see. Inventory turnover, cost of goods sold divided by the inventory. Again, it's like an efficiency ratio, and you want that to be high too. Days sales and inventory, 365 divided by inventory turnover. You want that to be low. Okay. Accounts receivable turnover, you want that to be high. Sales divided by accounts receivable. Days sales outstanding, 365 divided by accounts receivable turnover, you want that to be low. I don't want to have a lot of sales outstanding. I want to bring that cash in and book it as soon as possible. Asset turnover, this is both a profitability and an efficiency ratio. Total asset turnover is net sales divided by total assets. Fixed asset turnover, net sales divided by net fixed assets. This is your sunk costs. How profitable and how efficient are we cranking out the sales on top of our plant and equipment. Leverage ratios are really important too. Is the firm over-levered? If it's over-levered, then the firm could fall into bankruptcy. If it's under-levered, then it may not be performing, may not be providing the return on equity. There's a balance between leverage. You don't want to be over-leveraged, you don't want to be under-leveraged, you want to be optimally leveraged. And usually the indication of leverage will be based on historical experience from the firm, and then comparing the leverage to the direct competitor in the peer group. I wouldn't use the industry. So debt to total market capitalization, debt to total market cap is what it's called also. And it's basically the total value of the debt divided by the total value of the debt and the equity. Okay? And the value of the debt is basically the bond price. Okay? The bond price times the number of bonds outstanding. So if I know all the bonds that have been issued, and I know the price of those bonds, I can sum that all up and get the market value of the debt. And when you're conducting these ratios, some of them will be done at book, they were booked originally at cost, or they're gonna be mark to market. And you wanna look at them both ways. So I wanna look at debt to total market cap, at cost and at market value. And then the value of the equity is basically the stock price times the shares outstanding. That's it. So it's fairly simple. The other ratio, total debt ratio, it's the total debt to the assets. So it doesn't include the owner's equity. Can you move the camera over here? One of these days I'll have something that where the camera will be following me and then they'll upload it to the internet instantly. Maybe you guys can invent that and make us $1 billion. Think somebody would buy that. Where you can walk around and the camera's following you and then it automatically uploads the lecture to the course website. That'd be pretty awesome. Yeah, it would be awesome. Debt to equity ratio. So total debt divided by the equity. Again, you want that to be low. Equity multiplier, total assets to the equity, you want that to be high. Debt ratios, you want to be low, relatively. And then the profitability ratios, you've got gross profit margin, this is huge for most companies. Net sales minus cost of goods sold, so manufacturing companies divided by the net sales. Operating profit margin, earnings before interest and taxes. So get familiar with that, EBIT and EBITDA. Divided by net sales. Net profit margin, net income divided by net sales. EBIT return on assets, EBIT divided by the return on assets. Return on assets, net income divided by total assets. And then return on equity, net income divided by total equity. So these are key. Return on my assets, return on my equity, return on my cash, return on my assets, cash flow on assets, return on cash flow on assets, extremely important ratios. These are the first things people probably look at. I look at leverage and profitability. Probably go profitability first, then look at the leverage, and then look at the efficiency ratios. Market value ratios, earnings per share. So this could be net income or total earnings divided by the number of shares outstanding. This is going to give you earnings per share. This times the multiple is going to be the value of the stock. And I'll go through the valuation. So earnings per share is extremely important. The problem with earnings per share is it's great in stable time periods. It's bad in financial crises and recessions. Because EPS can turn negative. Well, can I multiply a negative times a positive to get a positive? No. So if I'm trying to value the share of the company, and the EPS is negative, and the multiple, I'm going to get a negative value. There's no such thing. Okay? So the loss carryovers and the impairments, the smoothing out of losses that accountants do to smooth out over time. At some periods of time, you got to take the losses and recognize them in the period, and could drive your earnings per share negative. So then you have to move to EBIT or EBITDA per share to get variables that you can use for valuation purposes. And you're going to use EBIT and EBITDA per share when you're valuing small companies, startup companies, because we look at the cash flows, not necessarily the net income. Price earnings ratio, so it's the price of the share divided by the earnings per share. If you multiply the earnings per share by the price earnings multiple, you're going to get the value of the company. You get the value of the company. And if you can predict the earnings per share, you can predict the PE multiple, you can predict the value of the company. Is that valuable? Yeah, because you're going to be pricing your options and your grants off of that. And you may be in a position where you want to invest in a company, and you're going to conduct the analysis and see if it's worth it. Because if your value is higher than the current price, you buy it. If the value is below the current price, you short it or sell it. So the analysis should be rules-based investing, not emotional, based on financial economics. Market to book, so it's the market value of the earnings per share divided by the book value. Most companies are going to be trading at some multiple market to book. When firms start to trade, their stock prices are below the book value or historical cost. Those companies are targets for takeouts. Because I can buy the company in the market for cheaper than the assets. So why don't I just take them out, liquidate the assets, or take out the company, restructure the company, and then turn the market to book positive, and then sell the company. That's what private equity firms do. The DuPont system, or the DuPont equation, it's the net profit margin times the total asset turnover times the equity profitability times operational efficiency times leverage. So it's your net income times net sales. You want that to be high. Net sales to total assets, you want that to be high. And then total assets to total equity, you want that to be high too. So if you multiply that, that's going to give you the return on equity, which is what every investor is looking for. Every investor. Any questions on the chapter? Yeah,
30 minutes.
30? I can do this in 30. Any questions? That should be pretty straightforward. Do you have this whole thing on the camera? Is the whole board on the camera? Yeah, thank you. So the next thing I want to talk about, let's break a little bit and then go back to the macro level and talk about yield curves, okay, and yield curve dynamics. Because yield curves are extremely important. Yield curves are interest rates or yield to maturities on U.S. Treasury securities, U.S. Treasury bonds that are issued by the U.S. Treasury to finance the budget deficits. Okay? And these yield curves, in most cases, are upward sloping, or what is called normal. This is a normal curve. So if you look at the financial press, they usually quote the interest rates on the bonds, and in some cases they will show you the yield curve, and they will show you the yield curve dynamics over time. Okay? And yield curves are extremely important because they are also the risk-free rate, which is the base rate, okay, used to value stocks, bonds, real estate, firms, you name it. So everything is priced off of the yield curve. That's why it's so important. And the book only gives like a little teeny little talk about yield curves because they assume that you know this stuff because you learned it in your macroeconomics course, which I'm going to assume you did. Okay. So nominal interest rates, the interest rates along the curve, and it's upward sloping, interest rates are also called yield to maturities on the bonds. Nominal interest rates based on Irving Fisher, who invented the Fisher equation, to basically articulate how risk-free rates or interest rates on government security bonds are determined, how the interest rate is determined. And he states that the nominal interest rates are real rates of return plus inflation expectations. Now, if I'm an investor and I want to buy a corporate bond or I want to buy a U.S. Treasury, I'm basically lending money to the Treasury in exchange for some interest rate. Now, I want to be compensated through that interest to give me at least some kind of real rate of return, but I also want to be compensated for inflation expectations, because the coupon payments and the principal payments that I'm going to get on that bond, or the maturity of the bond, is not indexed to inflation. So as the coupons come in And if inflation is going up, the value of the coupon, the purchasing power of the interest income is eroding and deteriorating. So the bond investor, the lender to the government, says, I want a real rate of return, but I also want to be compensated for the deterioration in my purchasing power due to inflation. So I want to be compensated for that. The nominal interest rates are also what are called the base rates. And I will go into how these rates are used to determine the cost of capital and the equity returns and the debt returns and the debt cost of capital. But these are risk-free rates. Okay? And I've gotten to points in the semester where I've asked students what the risk-free rate is, and they don't know. They don't know that the risk-free rate is basically articulated in the yield curve. They don't even remember the Fisher equation through the semester. Okay? And there's going to be equations that you're going to need to memorize and remember for the rest of your life. Okay? And the Fisher equation is one. Okay? The other thing you need to write down, and this is extremely important, is that you understand that all debt, all equity securities, all commodities, all real estate prices, and values are priced off of the yield curve. So if I want to issue a 5-year bond or a 10-year bond as a corporation or a government, say a corporation, the first thing I do is I go look at the 10-year treasury. That's going to be the minimum in which I'm going to have to pay investors to buy my bond. And they're not going to buy my bond, trust me, if I'm offering them the risk-free rate, because they want to be compensated for this. It's only the federal government, the Treasury, the Federal Reserve can print money to service the debt. Corporations cannot print money to service their debt. So investors want to be compensated. So if I'm going to issue a 10-year bond, first thing I do is I go to the risk-free rate. And that becomes my base rate or the risk-free rate, which is the starting point to do the calculation. Not only for the debt, but also for the equity. Because the average holding period for a stock is 7 years. So if I'm going to issue stock and I want to figure out what the cost of capital is going to be for me as the firm, or the expected return is going to be for the investor, I got to start with the 7-year treasury. That's the base rate. That's the risk-free rate. The second thing you need to understand too about these yield curves is that the short end of the curve, this part here, so there's the short end, the medium term, and the long end of the curve. Short end of the curve, this area in here, is manipulated by the Federal Reserve. The Federal Reserve controls short-term interest rates. The Federal Reserve controls short-term interest rates through open market operations by buying and selling bonds. When they buy bonds, bond prices go up and interest rates go down. When they sell bonds, bond prices go down and interest rates go up. So you have to memorize that relationship. Okay? You have to memorize the relationship. So you have to remember that the short end of the yield curve is controlled by the Federal Reserve through open market operations to stimulate the economy, restrict capital in the economy, to either stimulate to get us out of a recession, or to create asset price bubbles, or to quell inflation that's building in the economy. So the relationship, and I would write down this equation right here so you understand the flow, the dependencies. You can't just go from here to here. There's usually relationships. And I've used this model many times to understand and memorize relationships. So the first thing is, when the Fed buys bonds, aggregate demand for bonds is going to go up. I can use a supply-demand curve if I want to. So if the Fed buys bond, the aggregate demand curve shifts up. Bond prices shift up. Interest rates go down. The cost of capital goes down. Consumers and businesses borrow more. Consumption and investment increases. Employment, production, income, earnings, and profits rise. And bond and stock prices go up. That's the relationship. Now what you can do is you can change it and create the other. So if the Fed starts selling bonds, aggregate demand for bonds is going to go down, supply is going to increase. Bond prices are going to go down, interest rates are going to go up, cost of capital is going to go up, consumers and businesses are going to borrow less, consumption and investment is going to fall, employment, production, income, earnings, and profits are going to fall, and stock and bond prices are going to go down. So I would write out those two scenarios. Okay. The yield curve is extremely important to watch. Okay. We as financial economists and real estate economists and investment advisors are constantly monitoring the yield curve. Okay. One, because it tells us what's happening to monetary policy, and it's going to tell us what's going to happen to the economy and the stock market and the bond market. So the equation, just to do a simple valuation equation for stocks and bonds. If I'm trying to value stocks and bonds, there's going to be some cash flow that I'm going to get, coupon on the bond, or maybe dividends in the stock. Earnings. I'm going to divide it by some expected return, or what's also called a discount rate, or some cost of capital if I'm coming at it from the firm's view. So we know if cash flows go up, values go up. Cash flows go down, values go down. This is going to be economically driven by the economy. If interest rates go up, discount rates are going to go up, cost of capital is going to go up, and values are going to go down. Interest rates go down, expected returns are going to go down, cost of capital is going to go down, and valuations are going to go up. So you want to play with that model. Okay. So what happens to the yield curve is the yield curve could shift up through rising inflation expectations or a sell-off in the bond market. Well, when the yield curve shifts up, interest rates go up and valuations go down. The yield curve can also shift down due to lower inflation expectations or higher demand for bonds, driving up the prices, driving down interest rates. That occurs when the interest rates go down and the valuations go up. So all stock, all values, everything's priced off of the yield curve, because that's the base rate. There are four theories around the yield curve. First one is the expectations hypothesis, which is the Fisher equation. It focuses on the market perception of inflation expectations, not inflation, okay? When you're articulating this and discussing it, it's inflation expectations, it's not inflation. Inflation is a determinant of inflation expectations as the statistics come out from the Labor Department. But it's the bond market that has inflation expectations that determines interest rates. And note, the real rate does not move a lot. It's pretty stationary and it's pretty stagnant. It's very slow moving. So the majority of movements in interest rates come from inflation, changes in inflation expectations. So when the curve moves, it's due to inflation expectations, not changes in real rates. Although real rates are starting to move up. There's also market segmentation, preferred habitat, and liquidity preference. These are basically similar to each other, but it basically states that there are bond investors and bond issuers that prefer to be at specific segments along the curve. Businesses love to borrow and lend short because of the inventory turnover in the sales.
So if interest rates are going up, bond prices are going down,
Interest rates go up, valuations go down.
But-
Holding the cash flow cost.
so then stock prices, didn't you say that stock prices were inversely proportional to bond prices, or when people buy bonds?
This is just a simple model. I don't want to deviate from this right now.
Okay.
I mean, the growth rate and the cash flows, if interest rates go up, you'd think that stock prices would go down, right? Correct?
Yeah,
But if the growth rate and the cash flows are faster than the rise in the interest rates, then the valuations are gonna go up,
okay.
okay? Trying to keep it simple right now, because bond and stock valuations are slightly different. Because valuations for stocks are based on cash flow and growth rates. For bonds, the coupons do not grow. Okay?
Sounds good.
Okay, thank you. So there's the market segmented. So businesses like to borrow and lend on the short end of the curve. Pension funds and institutions and governments like to lend and borrow on the long end of the curve. Pension funds, endowments like to buy long-term bonds because they can match the liabilities of the pensioners. So I can match the maturities. I did the actuarial tests. I got liabilities coming due in 20 years. I gotta figure out how many bonds I need to buy so that there's enough money there in 30 years to pay off the pensioners. There are two types of markets too. There's the money market and the capital market. The money market are interest rates and securities on securities less than 1 year. Capital markets are securities with maturities more than 1 year. So stocks and long-term bonds or stocks and medium-term bonds would be considered part of the capital market. Short-term, what? Okay, excellent. And then corporate bonds and notes and government notes, and T-bills, less than 1 year are considered the money market. There are three types of yield curves. There's upward sloping yield curve, and then you're gonna have to, you might wanna write this down because it's gonna be on the in-class exam. Upward sloping yield curve, your inflation expectations are positive. Also, when the curve is upward sloping, it's never happened here in the United States that we've fallen into a recession when the yield curve is upward sloping. Currently, the yield curve is upward sloping, therefore there's a low probability that we're gonna fall into a recession.
Do you say that first part again about the upward sloping curve?
Yep, upward sloping, the upward sloping yield curve is due to positive inflation expectations. Very rarely, if ever, we've ever fallen into a recession when the yield curve is upward sloping, and currently the yield curve is upward sloping. So therefore, there's a low probability we're gonna go into a recession. But Japan has fallen into multiple recessions with an upward sloping yield curve. So that theory is violated in some global markets. Yield curves can also be flat, which means that inflation expectations are zero, and yield curves can invert. And when the curve inverts, we usually see a stock market peak in 12 months, and we fall into a recession in 24. So 12-month stock market peak, 24 months recession. So what happens is, you should see happening, and this is what we're watching for right now. Okay? What's macroeconomists, financial economists, and traders, and equity research people, and CFOs, CEOs, CIOs are looking for is we now have a normal curve. All of a sudden, the curve will start to flatten. the Fed starts to see inflation and asset price bubbles in the stock market. They'll enter into open market operations, start to sell off the bonds, and drive short-term interest rates up. Currently, that's what the Fed is doing. And you have foreign central banks and foreigners are selling U.S. Treasury securities, driving bond prices down and driving interest rates up. And because of the projection in excessive deficits that we're going to run under the stimulus programs, real rates are starting to go up. So you're seeing real rates go up, inflation expectations go up. Foreigners are selling off bonds, and the Federal Reserve is selling off the bond balance sheet that it's accumulated over the last 8 years after the crisis, which is pushing bond prices down and interest rates up. So the curve is starting to flatten. Once the curve inverts, and the Federal Reserve has already admitted, Janet Yellen admitted 2 months ago in Colorado, in Aspen, when they had their meeting of central bankers, she admitted on testimony that the Federal Reserve has been the precursor, has been the cause of all recessions post-World War II. Because what they do is they see budget deficits coming, they see inflation expectations coming, they see asset price bubbles in the stock market, and they start to sell off short-term securities, driving bond prices down and interest rates up. And then what they normally do is they make a mistake every single time, because they oversell the securities, driving the bond prices down further than they should be, causing interest rates to go up further than they should be, and popping the bubble and creating a recession. Go for it.
So is this about to happen, like, they're gonna start selling the bonds off because there's been such a rapid increase in bonds since Trump was elected? In bonds being
They are anticipating, they're selling off bonds, foreigners are selling off bonds because they need the money, okay, for the first time. The Fed is selling off the bonds because they accumulated $4.5 trillion in reserves, and the majority of those reserves are made up of U.S. Treasury securities, half of it, okay? We have $4.5 trillion sitting on reserve at the Federal Reserve Bank. Prior to 2007, we only had one. So the balance sheet is 5 times the size that it was prior to 2007. They need to liquidate because they don't know what to do. So they're now starting to talk about liquidation, and the statistics are showing that they're liquidating their positions. So they're liquidating, foreigners are liquidating, and through budget deficits, it's going to create more supply in the bond market to finance those infrastructures and the tax cuts, which is causing bond prices to go down and interest rates to go up. It hasn't flattened yet, and it hasn't inverted yet. It'll
But
be
it has been increasing, right? And
I mean,
now,
short-term interest rates are higher than long-term interest rates. The yield curve is inverted. Okay, once it inverts, the stock market peaks within 12 months, and we are in a recession in 20. So, do you think that's important to monitor? Because all securities, everything's priced off the yield curve.
so you're saying we're at risk of going back into a recession? essentially?
If the yield curve inverts,
Yeah.
and if this theory stays home.
Okay.
Because we've never gone into a recession with an upward sloping yield curve, but Japan has. So there is some international precedent. How much time do I have?
13 minutes.
Okay, good, I can do this. So I will show you the data. This will only take like 10 minutes. You want to type in your computers, you're going to type in your computers dynamic yield curve. Can you move that camera back over there?
Yeah, I got it.
Thank you. up to dynamic yield curve. I'm gonna show you the yield curve right here. And it's gonna show you the stock market. So remember we were so at the end of 98, 99, 2000, stock market peak. Recession 2001, 2, 3. Stock market peak 2005, 6, 7. Severe recession 8, 9, 10. Stock market peak, well, we don't know, right? So it's already blown through the two peaks, through the resistance, and it just keeps going. So the question is, if you look at it, what you're going to find is when I animate it, and push animate, what you're going to see is as you start to approach stock market peaks, the yield curve is going to flatten, and right before the peaks, it's going to invert. And then what they do is they come in and they know we're going to go into, they pop the bubble, and we're going to go into a recession. So they start to buy bonds very rapidly on the short end, driving the curve back down, and then upward sloping, very steep. So this is what we watch every single day. This is what we're watching for. Because I got to be able to predict the recession. So here's the problem. Interest rates are still extremely low by historical standards. This is zero interest rate policy. Are we in an asset price bubble? Why isn't the Fed raising interest rates here? Could this be a mistake? Could the Fed leave interest rates low too long and create an asset price bubble in the stock market? Or do you just continue to print money and keep interest rates low and let the market go up forever? Has that ever been done? No, never been done. You operate in a cyclical environment. We go through recessions, recoveries, peaks, decline and troughs, over and over again. I've been through at least 3 or 4 of them in my lifetime. So look how high the yield curve was compared to where it was today. And watch it, it's going to invert. So it's flattening, and then watch, it'll invert. Bam, inverted. And then all of a sudden, it pops the bubble. And watch the Fed will start coming in and start buying securities, driving up bond prices, and driving down interest rates to try to create a floor on the market. Because they don't want a stock market crash, that's all your wealth, basically going up, going down the drain. So they're going to drive interest rates really low, particularly on the short end, to try to mitigate the stock market damage in the crash. Then what it's going to do, very steep upward curve, it's going to stimulate the economy, and since stock prices are forward-looking, it's going to cause the stock market to recover and rally again, based on very cheap capital that's being pumped into the system. So the Fed is printing money and buying bonds, driving up short-term bond prices and driving down interest rates to stimulate consumers and investors and businesses to consume and invest. So watch. So as we start to approach the peak, the Fed is selling off, the curve is starting to flatten, and then tell me when it inverts. It looked like it just inverted. It looked like it even inverted. Just not too, now it's totally inverted. So what's going to happen now? Pop. And then this one was a lot worse than this one. So flatten, invert, and then watch, they're going to start coming in, start buying bonds again, driving up bond prices, driving down interest rates, driving down cost of capital, and getting consumers and investors, and businesses to invest and consume through cheap credit. They set a floor on the market, and this is what's totally unprecedented, is they went to zero interest rate policy, never been done before in history. And actually in Japan and Germany, or in Europe, they actually took it negative. Never been negative interest rate policy in the history, monetary history, ever.
What's a negative interest rate where the government pays you to borrow money?
They're basically, no, you're paying them. You get negative interest. You are paying the government to buy my bonds. I'm giving you less negative return for you to buy my bonds. The only reason why you would do that is fear, that the system's gonna collapse and you need liquidity. And you wanna have government-backed securities because they don't default, but you're willing to take a negative return. Never been done. And on the exam, I asked you, if we fall into a recession within the next 2 years, will the Federal Reserve drive interest rates negative? The answer is yes. She's already said it. We'll do it. We'll do anything we have to do to stimulate the economy and revive it. So unorthodox monetary policy. When you drive interest rates negative, it props up asset prices. It artificially props them up, not due to cash flow growth rates, but due to cheap capital and low interest rates. So it's perverse monetary policy that has an effect on stock and bond prices. Now this is not in your book, and actually your econ books probably don't do a good enough job to talk about this, but we're in finance, right? And we have to be thinking about this. I gotta know when to issue the stocks and when to issue the bonds. Do I issue bonds? Do I issue stocks? What's the value of my company today and tomorrow? Do I use more leverage? Do I use more bonds? Those are all decisions we have to make because I'm gonna take that money and I'm gonna invest it. Either we're gonna buy another company, or we're gonna buy plant and equipment, we're gonna buy some real estate. We're gonna take that money and invest it. So I don't know about you, it broke through the resistance, just seems to keep going. I think it's at an all-time high today after that presidential meeting with the major manufacturing CEOs in Washington this morning, and the market just keeps going. And the perceptions of the market will end it is that earnings and profitability and dividends are going to continue to grow based on expectations of deregulation, lower taxes, and an infrastructure spending bill. And those haven't even been discussed. And those haven't even been discussed yet. They're just rhetoric. So the market is in extremely dangerous territory if those expectations on those deregulation, infrastructure bill, and tax cuts don't go through. This market's going to crash because it's all being propped up by cheap money and expectations, future expectations, which is not reality. Okay, so I'll end it there. Thank you. And if you didn't hand in your, could you turn off the video for me, please? Yeah. Thank you. If you have your statistical pre-test, will be handed in on Tuesday. I'll take it from you. Thanks a lot. I appreciate you.